I'll talk about the numbers. So we talked about the business, my journey, business model, and the numbers. You might have already seen it, but this may give you a refresher to be able to ask questions from me. Revenue trend, starting from 2011. The CAGR, this is in dollar terms. Rupee terms, it shows high, about 30% that you might have seen into our earning calls. But we are mostly internally we track in dollars. The rupee exchange gains and security picture. So CAGR so far has been 23% since 2011. The current, last 6 months were not with the same velocity, slightly lower for the reasons we talked internally and also to the investors. But the traction is good. The business model is solid to give us continued growth for many years to come. And you would notice that web growth is higher than TV sales. And the slowest is B2B, very small component. B2B consists of two avenues for us. One is we still have the division that used to sell to QVC or Shop HQ or Signet. And the other is the exit of excess stones that we buy from auctions that we sell in India and China. So this is the component. Volume. You notice the volume is higher than the sale. The sale is growing as 23%, the volume is 47%. There was a factor of reducing price point from the second year. From financial year 2011, it was 41%, came down to $41, came down to $23. This combination is a metric from US and UK. UK is 22 pounds, UK is just under $20. Web volume is growing faster than television. Gross margin trends. One of the biggest advantages we have as a manufacturer or the vertical player is having phenomenal gross margins. The other factor that plays into it is the house brands. QVC, HSN, they both sell mostly third-party brands. They do have some house brands, but mostly third-party brands. And that tells into the gross margin. That's a phenomenal model. QVC, HSN, they both have great models. But the gross margin is low. I like Zara model better. They have 60% plus gross margin because they only do house brands and partly internal manufacturing. At 63% gross margin, our EBITDA is only 10% or 11%. That means our operating cost is pretty high, more than 50%. That offers us some potential for leverage as we scale, that I'll show you later. PAT from 8 to 12%, depending on the depreciation, tax, and interest cost. Earning per share has been going up except the last 6 months. Balance sheet, shareholder equity, about in dollar terms, approximately similar, 45 million. In financial year 2013, we wrote off some goodwill that was related to the wholesale business. That is not reflected here. That reflects in fixed asset. In 2011, we wrote off that goodwill, and since then, the fixed asset is in the region of $11 to $12 million. Net debt, there is gross debt minus the cash we have, is constantly going down, and we hope to be debt-free by the end of this financial year. Not totally debt-free, but I would say on net debt basis. Net current assets, showing at $39 million. As you would see, the sales have been going up at 23% CAGR, but the net current asset has been pretty stable. That tells into inventory turn efficiency that I talked about. Cash flow. The operating cash and free cash flow has been steadily growing because capex requirements are pretty low in our business. ROE, ROC in the region of 27% to 40%.